Welcome to Entrepreneurial Genius, the podcast where spiritually conscious entrepreneurs get a grip on their business, their health, their money, their relationships, and their life. And now, here's your host, Paul.
All right, so welcome to another episode, and in today's episode, I am joined by Richard Wilson, and welcome, Richard.
Great. Thanks for having me here, Paul.
Yeah, you're welcome. And so today's topic is one that I've found intriguing for a long time, and I was put on to Richard by a mutual friend, and because of his work in a specific niche with centimillionaires and family offices. And we'll get into that in a minute, exactly what all that means. But Richard's the author of a book, Centimillionaire Migraines. And the fine print is, the subtitle is Proprietary Remedies to Turn the 6 Most Common Headaches of $100 million plus net worth individuals into Points of Strategic Advantage. In the book, Richard goes through the 6 key, what he's discovered to be the 6 key headaches or pain points for people and families with 100 million plus net worth. And so we'll talk about that. Again, welcome. You're in Key Biscayne, so welcome to the show. And how did you get into working with families and individuals with net worths over $100 million?
The short version is that I found while meeting with them the first couple times, almost on accident, that I said, wow, why don't I just spend 100% of my time meeting with people like this? It's so much more powerful. There's so much more leverage. And as I tried to do that, I found that no one was being helpful to me. There was no trail guide. If you want to learn the stock market, there's Susie Orman and Kramer and Warren Buffett and, Ray Dalio and smart people who are great at investing in the stock market. But if you want to learn about family offices and the ultra wealthy, there was no trail guide for me. So not in a plan to position myself at the beginning, but just to teach myself. Every time I would meet with someone or read a few articles and get insight on a new trend, I would just share it online. And then on accident, I got invited to speak a couple hundred times in 14 countries. And then I got a book offer from Wiley. And then I said, oh, well, maybe I should keep doing this for all sorts of reasons. And then we bought familyoffices.com, and it kind of took off. So it'll be 12 years this June that we've been doing this.
Mm-hmm. Awesome. By accident, after several hundred talks and book offers. So I like the way you kind of split that in right there.
Well, I mean, at the beginning, it was very selfishly just trying to teach myself everything I could know. I was like, well, there's no downside to teaching myself. And by synthesizing information and putting it online, I would really ingrain it in my brain. And that was my sole intention, just to selfishly teach myself. And then it taught others, and then it gave me connections. So it kind of took on a life of its own.
Yeah, interesting. Yeah. So, for our audience, describe or define a centimillionaire. Who is that? Where do they show up? What's the overall mindset? We'll dig deep in a few minutes, but the overall mindset of a person in that economic realm.
Sure. I love defining centimillionaire because it couldn't be more simple. It's just somebody worth $100 million or more. If we talk about family offices on this podcast, it's probably important to know that a family office is typically a full balance sheet or full life management solution for an ultra wealthy individual. And there's only 2 types: single family offices, so the whole organization is built for one person, or a multifamily office, which is like a wealth management firm serving dozens or maybe even hundreds of people that are worth 10 million, 50 million, or $100 million plus. And the reason why the word centimillionaire is so important is everybody talks about billionaires, but there's only 3,000 of them globally. Well, there's 50,000 centimillionaires globally. They have less gatekeepers. They still need a ton of help, but nobody talks about them. There's 12 full-time reporters dedicated to billionaires at Bloomberg. There's not even one dedicated to centimillionaires. And so in this area, it's also important to note that smaller clients go to multifamily offices until they get to 30, 50 million net worth. And then they might want something that looks like a single family office in place. But when you get to $100 million of net worth, you for sure need family office quality solution providers and structures around you, or you're going to be paying for it anyways through lost money. So, at some point, especially when you get up over 100, you're paying for a family office, whether you have one or not. And that's why the Centimillionaire word is so important, because it's just very clear. People throw around these other words like ultra wealthy or super rich or super wealthy, or, the top 1%, the top 0.1%. No one knows what any of that means, where Centimillionaire is very concrete.
Defines it. It's measurable.
Right, exactly. And it's discrete. So in their mindset, I mean, really, the clients that we work with are 90% first generation or early second generation families, meaning the next generation is just starting to take control of the business holdings. And so they are entrepreneurs at heart, and they grew a real estate portfolio or their operating business. Like my two clients I'm onboarding right now, $300 million tech family, guy's in his 40s, a $250 million manufacturing family, second gen is starting to take over, father's in his 60s. And they both are wanting to put in place a family office structure because they want to maintain control and maintain the strategic advantage they have, while also being smart with taxation, diversification, and part of their portfolio, cash flowing commercial real estate and part of it, and just have a total solution that creates the new reality that they want to live in now that they've had this liquidity event.
Mm-hmm. That answered one of the questions that I was thinking while you were describing it. Is this new money or is this old money? 90% of it you say is new.
90% of my clients are new money.
In this generation, I guess.
First or second gen. Yeah, the thing that I've found is that if somebody has been around for 3, 4, or 5 generations, one is they've figured out a lot of things already, hopefully, over those 2 or 3 generations. If they haven't, they've probably lost all the money. Second is that sometimes, more people lay claim to the family wealth, the more generations go down. So after 4 generations of everybody having an average of just 2 or 3 kids, and then them having 2 or 3 kids, and them having 2 or 3 kids, you get into hundreds of individuals laying claim to the assets. So unless the family office structure is structured just right, or they're highly successful, $500 million spread out over 300 people, the wealth dissipates between getting everybody their first house and a college education, in any inheritance at all. And the wealth really dissipates over time within some of those families. Many of them do have trusts, foundations, commercial real estate assets that will live on forever inside of trusts, etc. But the first gens and second gen families need the most help. So it just happens to be that 23 of our 26 clients are first gen or early second gen.
Is a big part of your work advising how to distribute their wealth to successive generations?
Yes. We usually refer to it as like
who deserves it. Who's entitled, who deserves it, who's in line for it. What are the parameters for one to receive it? Those sorts of things.
Right. For sure. And we talk about governance. So it's about the rules of running the money, who's going to get it for what reasons and why, and the family needs to design a plan for that. I love talking to the idea about a family bank where instead of giving the kid enough money where he can go live in Monaco and drive a Lamborghini around all day, perhaps help them get education, help them buy their first house, and then perhaps the younger members have to apply to the family to receive funds to start a business or to invest or buy a business. And it's not approved unless the idea actually makes sense with, the reality of the real world and their skill set. And I just really like that idea because, Buffett says that you want to have your kids have enough money to do anything they want, but not enough money to do nothing. Nobody wants to grow up a bunch of drug addicted, supercar drivers. But that's what happens with unlimited money. There's no limit on anything, no responsibility. You don't need to be resourceful. And it's a big challenge for families where a lot of their drive came from not wanting to be poor or growing up in a bad situation and going through a lot of stress and a lot of hard work and just paying those debts basically to get to success. And then their kids go to $40,000 a year grade schools and they have 3 private jets and a house in Zurich on the lake. It's very hard to instill the same resourcefulness, and you have to be thrifty and watch for the exchange of value, and you pay money for anything. And, oh, by the way, why don't we get you involved, son, by running our impact investment division and foundation? You can just give away money all day long like it's coming out of our nose instead of learning how to create value in the world. That's like a big problem for families. And for some, it's too late. There's already a kid or two that's just going to play video games the rest of their life, and they've given up. And they're like, well, he's the lazy guy in the family and whatever. Mm-hmm. We'll let him inherit some money. But, the active family members are going to get more.
Mm-hmm. Yeah, I was pleasantly surprised when I read the statistics. You noted a little bit earlier, 3,000 billionaires and over 50 or 60 centillionaires, and it's growing. And then according to your book, we don't even really know if that number is accurate because they can be a little clandestine with where they are, where they hang out, how you access to them. But even that number is growing.
For sure. There's more now than ever before, and there's two ways where those numbers are wildly inaccurate. And if you look at all the credible sources like Bloomberg and Financial Times, they're all at about 3,000 for billionaires and 40 to 60,000 for centimillionaires, and they're very inaccurate for two reasons. One is that means it's an individual and the spouse. If they have three cousins who are also worth 800 million each, they don't get on the billionaire list because they're only worth 800 million. They're not a billionaire, but the family is $1 billion plus. The other reason why it's inaccurate is that in Asia especially, but also South America, if you're in Brazil or Malaysia or Indonesia, you don't want too many people knowing that you're worth $800 million. So you're not raising your hand for some statistic, and you don't want the government confiscating your assets or creating new regulations, or somebody kidnapping your kid when they go to their private school in the morning. So many families underreport, and the wealth is broken up between several business partners that might be in the same family. So there's just a lot of wealth out there, and there'll be even more a decade from now. So I think those in real estate or business could do well by seeking, co-GP investors, seed investors, joint venture partners, people that can help with distribution of a product or have a big real estate portfolio and can leverage that credibility with your innovative opportunity zone idea to, deploy capital or open up doors, et cetera. And I just think that those early on the whole family office trend, I was just speaking Saturday to 200 people. They were all real estate syndicators and independent sponsors. And I was telling them that if you are early on that trend, then you can be better at identifying what local family offices are there to partner with and be up on this trend where in a decade there might be twice as many opportunities, and you'll already be up the learning curve on how to navigate this space.
Interesting. So in your book, you talk about the 6 main headaches or problems that families or individuals in this realm would have. And I guess a lot of people would go, well, if you got $100 million, what kind of problems can you have? Come on, get real, buddy.
White collar problems.
Right.
It's got to be another level up for those problems.
Right.
You don't need a collar when you're at 100 million.
Okay. Rough world, huh? Okay. But seriously, I mean, at each economic level,
right,
wherever you start, there's a set of problems, and each are unique to that economic stratosphere. And
sure.
So centillionaires, and I would suppose that centimillionaires have a different set of economic or migraines, as you say, than billionaires.
Right, for sure. I mean, go ahead.
Yeah, I think you said earlier that a lot of the old money has figured it out, right? So they've got a path right there.
Right.
But this newer money, what are the biggest? Well, I mean, you talk about blurred vision. I mean, I don't want to give away the farm here for you because I want people to go out and get your book, and we'll talk about
No, I don't mind, because the remedies hopefully go a lot deeper than just knowing what the problems are. So I don't mind you giving away as much as you feel like it.
Okay, perfect. Blurred vision, controlled conflicts, a feeding frenzy, deal flow deficient. By the way, feeding frenzy, I think, is self-explanatory, but I'd love to hear about that.
Sure.
Deal flow deficiency, time constriction pains, which I found the most interesting. Second only to family feuds. So
sure.
Those are your 6. Like, which one do you really think you deal the most with, and then which one can have the most detrimental impact on a family?
Sure. So I think there's a deep thinker, Sean Combs, which is also known as the Puff Daddy, who said more money, more problems. Yeah, P. Diddy. I don't know what he's called nowadays, but
what's his line? What did you say his line?
More money, more problems.
Yeah.
Right. And so, I think that just comes with territory, right? Things get more complex, and everybody wants more from you more frequently. So you just get pitched all the time. Everybody wants your business, your service, your time, et cetera. So for me, the most important thing in life and business is to have everything integrated. I don't care if you're a multifamily sponsor and you've only done your first deal, or if you're a $1 billion family. If you don't have everything integrated in your life and business and vision and objectives and who you are and what your strengths are and what you do every day in life, and that's not all aligned, then I think you're just getting slowed down and you're conflicted everywhere. And so the most important thing for me when I work with clients is the blurry vision headache. That's why I put it number one, because if I can help solve that, it releases stress, it decreases chaos, it gets the right solution providers that are aligned with their vision. It lets the family members know which way the boat is going and see how they want to be involved and where they could be, what's the right seat for them on the bus, as Jim Collins would say. And I think a lot of the other problems get de-risked if you have an excellent vision that's well articulated through a family office dashboard, and then you only do things that are aligned with that vision, and you clear your calendar of everything else that people are trying to pitch you. And there's other ones on here that are very important, but for example, family feuds, how those are resolved or prevented changes based on your vision. What are your priorities? To become a billionaire or to grow the most well-rounded human beings possible in the next generation and spend every dollar before you die? Those are completely different visions, and the family feuds are going to, totally change the type of feuds that are most likely to happen, or how you de-risk them, or how much money you would put into de-risking them by bringing in a therapist or a collaboration expert to coach different family members or mentor them. So that's why it has to be most important. But the most painful. Go ahead.
Is that usually led by the patriarch? Like the one who brought the 100 million to the family, or is that a collaborative family decision once they have reached the centimillionaire mark?
It's usually the person who creates the wealth is the one whose vote matters most, because he's trying to say, here's the principles that made us so successful as a family, and I want these to carry on. And we're going to act on the principles, but also push them down to the next generation, because without the principles and the values, the wealth is going to get destroyed and the family is going to destroy each other. So the values are what allows the family to succeed in the jungle like they have to date. Without the values and principles, you're just diversifying your assets and paying someone a fee to do so and slowly losing all your money. So I think that...
Is there pressure on the family members to acquiesce to the leader's values that he's established so that they can fall in line for this inheritance or the benefits of the...
For sure.
Yeah.
For sure that's there. I mean, with some families, a lot more than others. Some families are more relaxed about it, and they know each person's their own person. Others say, well, we're going to give this much to each family member. Maybe it's 5 million or 10 million, who knows? But it's different for a family. But then you only earn more through working in the family business or through applying yourself to that business idea. So that just depends on the family. But definitely there's some pressure there. But I think the most painful one is family feuds, because many people, if they got really down to it of oh, well, why do you work so hard? Why do you try to create so much money? A lot of it comes down to creating freedom for themselves, but also for the people around them. And so if they really dug deep enough, they would put the family staying connected and talking to each other above losing their assets. But a lot of energy goes into the investment side, and sometimes not a lot into the relationship side or digging into what the problems are to move things forward. And so I think that is an area where there's a lot of families get caught by surprise by people getting bitter over things they didn't even know was a problem. But for a decade, two family members didn't talk to each other because of something, or maybe a son is put in charge of some assets, but he's not paid for it, even though it's a full-time job. And then he loses some of the money. Now all the family members are upset with him. Or he hires his old college roommate, and then the college roommate loses money for the whole family, and everyone thinks he just hired his old best friend, when maybe the guy was the most legitimate person possible to hire, or not. But when there's no family governance, there's no rules of the game set, then there can be a lot of bitterness and unset expectations. So keeping the family together through quarterly family meetings and a required kind of family annual trip to somewhere enjoyable just to spend time together, and then making sure there's good communication. A lot of the things I work with on families are taking business principles and organizing where they want to go, and then helping create the solution to get them there. We're creating the vehicle to get them there, and taking everything that's in their brain about their wishes, their mission, their goals, objectives, their solution providers, potential investment deals they want to do, current assets in their portfolio, everybody who is working for them and supporting them, and putting that all into a plan, and then helping move that plan forward every month in a systematic way. It just makes such a huge difference. There's a lot of people out there that want to sell a $300,000 a year software installation, or sell a hedge fund product, or a real estate investment to the families. But at the core of it, they really need to get their thinking straight, or they'll have no idea what to say yes or no to, and their team won't know what to pass on to them or not.
Yeah, I'm hearing from you that it's a very holistic approach to wealth management.
Right.
Values,
for sure.
Mission, vision. What was it? Stephen Covey that said, "Begin with the end in mind." And,
right.
And then it's a work down from that. And
for sure,
I guess that would. Well, yeah, I guess that would work. If all the visions and missions and purposes were all in line, it doesn't really matter. Or let me say it this way: it's more palatable in the event of a loss of the wealth, or an adjustment in the wealth, if the vision is still in line, which is the case for all businesses and life, basically.
Right. I mean, what's most interesting is, like, some of this stuff, it takes asking, 50 of the right questions and going through a process. And we've helped, over 100 family offices start their family offices now. So we've learned a lot of the nuances of that. But at the basic level, it's like, why doesn't every family office have some bad version of this in place? And the truth is, I don't know if I've ever once gotten a straight response when I asked a family what their vision was, or what their exact objectives are, or what's your exact strike zone for your investments. And a single family office that's only been around 2 or 3 years almost never has those two things. And it's so simple. And the problem is, everybody is going to be wanting to get a meeting with you and get on your calendar and to pitch you something. And you have to say no to 95% of those people, or you'll be dead. I mean, I think that when you're gaining your wealth, every wealth management person says, diversify, go into uncorrelated assets. It's like the whole game, and that's all they ever talk about. The reality is, that's the stupidest idea on planet Earth if you're doing direct investing. Like, if you invest in a biotech company, cannabis company, some new opportunity zone fund that has no idea where they're going to put the capital yet, a medical device company, self-storage, and apartment buildings, and you do that all directly, and you say, well, those will be the 12 areas we're going to invest in. Imagine the difference of doing that, even if you close 4 deals a year or 8 deals a year, versus saying, well, we made our money in medical devices, so we're only going to invest in medical devices, only in US-based companies that are already FDA approved. They're already doing at least $5 million in revenue, but under $100 million, where we can have majority control, or at least be on the board and have some negative controls in place. And then on the commercial real estate side, we're going to find the best in class independent sponsors, but we're only going to allocate to self-storage and mobile home parks, or multifamily and office parks. And because of that, we'll get to know 50 or 100 independent sponsors in those two niches. And everything else will outsource the diversified wealth management bucket to a great private bank or multifamily office. But the internal stuff will be selecting those independent sponsors in those two CRE areas and medical devices in the US that already have traction. And if that's all they did, just after looking at 30 to 50 medical device deals in that area, which, by the way, they already know because they made their wealth in that area, they would have higher conviction valuation, faster due diligence, specialized providers to help them move forward, platforms. Every time they invest, they're injecting all this value from their back office operations and distribution abilities. And they would just become such an expert at navigating the medical device space that they would see deals in that space first, exclusively, more often, and at a better valuation than anyone else, because everyone knows they're the medical device guys for someone who's got a serious device that's starting to get traction. And so when you look at the CRE space, even if they didn't make their money in real estate at all and just buying their third home and an apartment building on the corner was their only experience to date, being laser focused on self-storage and mobile home parks, again, after seeing 30 to 50 deals, they'll start to feel like, oh, okay, I get kind of the rhythm for what's the standard deviation of like an average deal that's boring and everybody's offering me that same deal the same 17% IRR promise. Maybe we'll hit 20, the same 8% preferred, and we're going to charge you 20. And then after 12 hurdle, we're going to charge you 40%, sponsor fee. If everybody is saying that, then they start to look for what's abnormal, what's very exciting, what's a more aligned structure, a more aligned fee schedule, an excellent location. And then they can become experts on that so much faster and produce better returns. So I always tell families you should have almost zero control in the diversified bucket and just find the smartest person possible to do trust and estate planning, taxation work, and your diversified bucket of assets. Whatever percentage that we decide you should have in there, outsource that and have almost no control. You're just telling them what your goals are and they're getting to know you. Then in the middle level, you have commercial real estate. And unless you made your money in that area, it's a middle, moderate level of control and transparency. So you could go direct on some assets and just get a property manager. You could go semi-direct through an independent sponsor or co-GP or JV with them. Or if you really love someone, you could go into a fund. But that way you're kind of have more transparency project per project. You're not just giving it all over to someone and saying, no, please don't lose my money. You're really injecting some insight on what you believe is true in the world. And then the third bucket would be like the medical device example. Say that's where we're going to have 100% control. We know exactly what's going on day to day, and we'll replace anyone on the team that's not excellent, that's not aligned with where we're going. So having that structure
seems like in that
helps.
Scenario too, they could also become influencers in that space, or continue to be influencers in that space.
Yeah, for sure. And sometimes families make their money in something like auto dealerships, but then they say, okay, you know what? That game has been played out. The publicly traded companies make these things hard to buy nowadays. We think stem cells is going to be big, so we might look at auto dealerships opportunistically. We have a lot of value there, but let's put a stake in the ground, and we're going to become experts at investing in stem cell therapies and centers. And even if their expertise didn't come from that area, they take their business DNA, find one niche, maybe two at most, but usually it's one, and say, well, let's look at 100 deals in stem cells and go to every stem cell conference, get on top of that trend and read everything we can on that space. And then 2 years from now, after looking at 100 deals, our goal will be to allocate to 2 deals in our first 2 years, and then allocate to 1 deal per quarter, or buy one central platform asset to add things onto. And some families take that approach, but more important than anything else is just to think about those 3 buckets of control. What's appropriate for the family after getting to know them very well, and then not making other exceptions to simplify your life and de-stress things and improve your returns so that you're moving up the learning curves because you are so focused while the rest of the world gets distracted with bright, shiny objects.
Is there an average return that you would say is what these family offices are looking for? Or does that depend on the space?
It depends, but some guidance would be the most conservative families look to generate 8 to 12% returns overall in their total portfolio of investments. But I would put that down as their kind of market exposure investments, the fully diversified bucket. For commercial real estate, cash flowing deals that are not development, I think a lot of them are looking for that 12 to 20% IRR, and anything over that, they're very happy with. And then on the for their holdings that are not liquid, they don't really talk in those terms to me. They're really looking for the long term on how to dominate a niche, or kind of like monopolize a type of intellectual property, or do something that they're passionate about that is a big plateau they want to climb to over the next decade or the next 25 years. So one of my clients, their goal after their exit 2 years ago is to buy a platform company, buy several add-ons, maybe 1 or 2 per year, and their goal is to grow their next $100 million year in revenue company. And they're very long-term minded and strategic about that. So some assets might be more profitable than others, but they might play a part on that platform of getting them additional deal flow, or getting them additional momentum or strategic alignment with more distributors in their space, et cetera.
Mm-hmm. And then how does philanthropy play out in all this? Like, is there an allocation for that? Is there a mindset that the philanthropy will produce profits, which in turn would then produce more philanthropy and more profits? What's that mindset there usually?
Sure. Sometimes not at exactly 100 million net worth, but at 2 to 300 million, especially over 500, almost every family sets up some sort of foundation or finds one they love and creates a custom plan with them for donations. So setting up their own foundations is typical. And at those levels, you start to run them at a professional enough level, especially above 500 million net worth, that the investments might be handled in a way where the only money given away is the interest off of the investments made in the past. So the core money stays in place. And then the interest coming off the commercial real estate investments made by the foundation might go to the causes. And that way it's a perpetual foundation that should be around forever in theory and managed by some people appointed to do so. So that is common. I mean, every client I have donates money and is philanthropic. They don't sometimes bring it up to me because they might have already found what that cause is. And then many times the wife or a daughter or someone else in the family might take on that responsibility and overlook that area. And then sometimes people talk about doing impact investments where the business investment is supposed to make money, but also it's tied to a social cause. And the UN has some impact investment kind of buckets or principles, or I think there's 14 or 17 of them. And then the family can go through and say, oh, well, these are the 3 causes we believe in. So let's try to find investments that are solid business investments, but also are helping push one of these causes forward.
Mm-hmm. Okay. If someone had an investment that they really believed that, and first of all, I imagine, well, let me see, was it with a chapter on time constraint pains, saying no? That was the upshot of you can't respond to every single proposal that comes in, nor should you, but based on your vision, you have to have the ability to say no, or the ability to say, okay, let's take a serious look. But let's say someone had a legitimate product or investment they wanted to present to a family office. What is what should they consider? What should they contemplate? What's the path for them to take a look at in order to get in front of a family office?
Sure. Well, one of the most important things to consider is that any informed investor who's seen a lot of deals gets worn down and a bit tired by all of them looking the same after a while. All the multifamily independent sponsors are all saying they've got some 236 store complex under contract that's underwritten at some good number, and they've all got some sort of track record, et cetera. So it all kind of blends together, and my clients are all drowning in normal, so they want things that are abnormal. And so you have to know yourself very well, your competitors very well, and then the type of investor you're going after very well. Are you going after real estate families that are local to the assets you're buying? Are you going after business families that might not have familiarity with your asset? And after you know what game you're playing based on who you are, your competitors, and the investors,